Hello and welcome, dear investor. My name is Thorsten Tiet. I'm the founder of Dividend Stocks Cash, spin-off of a very successful stock screener in Germany. It's all about long-term investing here to profit from capital gains and growing dividends as well. We take a look at Walt Disney, fairy tales at all costs. I could also have named it fairy tales at any price, because you will see that the stock price is a decisive argument against the stock to buy the stock right now. We will look at the Walt Disney from a fundamental perspective, and at the end you will know a little bit more about the stock as before. This analysis was also done on the blog, so I will give you a link, then you can read very much the same. Just some details will be different because this author who wrote the article is another one. It was not me, and I will emphasize a little bit different perspective. So let's start. And here you see the homepage, and here you see Walt Disney chart from the last starting in 2014. But I want to show you a little bit more, just to give you an idea about how the stock did in the past. You will see different phases. Let's start covering up in 2009 with the financial crisis. After the financial crisis, the stock was a nice buy, a lot of capital gains till 2015, mid-2015, then a phase of stagnation here, lasting about 4.5 years. Then suddenly the stock got a boost, the stock price got a boost. It was related to the streaming offensive, Disney Plus, which started in autumn last year, 2019, November, if I remember well. Then a phase of a little bit of stagnation or still slightly capital gains. And then, of course, you know what this means or what's the reason behind this. It's the Corona pandemic, the outbreak, and then now the recovery phase. And if you were an investor and bought here at the low, then you made already very nice capital gains in a very short time, within a very short time frame of up to 50% and even slightly above. But who of us buys stocks really at the absolute low? No one of us does, because nobody of us has the glass ball. So, but we don't need it if we do a good fundamental analysis. Question is, right now, or the stock price is exactly here, 115 US dollar. And is the stock still a buy or not, Walt Disney? So let's see. Walt Disney, what do they do? A short presentation of their segments to get you and to give you an idea. And maybe we use the FactSet workstation here. It's like a Bloomberg terminal, just from another company called FactSet, which is the main data provider of Dividend Stocks Cash. And I want to give you an overview of the different segments. We have 4 right now. A big company like Walt Disney is going to change their internal structure, the segments for reporting. And here you see the historical segments. So they had 3 segments for in the history, and now they have 4. The 4th segment is direct to consumer and international, and this is where the new streaming services, the concurrents or the new Netflix, if you want, are living, are included. They are still reporting losses. You will see what that means for the margins in a very short time. But let's cover the 4 segments first, from after the next. Park experience and products. Here are the theme parks included. There is a cruise line, for example. Everything is here, and this is where most revenues are done, 26 million so far. And before it was reported as segment Parks and Resorts, now is Parks Experience and Products. Media networks is the old TV world, the old TV stations and everything, but it is not streaming services. This is also a very important segment for revenues and operating income. Then they have studio entertainment. This is where all the blockbusters are done, merchandising. And then they have this direct consumer international. And this is where according to analysts and a lot of people, the future is. And if you look at the operating income, you will see that the streaming segment is still posting losses, and the other segments are positive. So they report earnings. Let's have a better idea of Walt Disney, analyzing it in the screener. And we are now doing a little bit more fundamental analysis. We will ask questions about the long-term profit growth, about decisive events which happened in the last years, and then also we will cover the dividends and dividend safety, because this is a hot topic for investors of Walt Disney right now. So here's Walt Disney. Let's have a look at the long-term earnings and profit growth, which is absolutely decisive for you if you want to profit from growing dividends and capital gains. You see that starting from 2000 to 2018, until the outbreak of the Corona crisis, the direction of earnings and cash flows was fine. So from the bottom left to the upper right, also thanks to share buybacks, you see it here, there's a number of outstanding shares, and it's constantly declining till very, very recently, which has to do with the merger of, not the merger, Walt Disney bought 21st Century Fox. You see it here, there's even a Wikipedia entry. And because the stocks declined so far a lot, there's earnings per share metrics got a boost, because we have the earnings per share, which is based on organic growth, and then we have earnings per share based on share repurchases, or thanks to share repurchases, because the number of shares is reduced, and you see that is always Walt Disney per share metrics always got a boost since 2011 to be exact. They always got a boost till or except 2019 from share buybacks. So the direction was fine so far, and you could ask yourself now, if you look at this, if you look at the growing earnings, at the growing cash flows, at the growing dividends, and you might expect that we always had capital gains starting from 2009 financial crisis till 2018, and maybe 2019 till the outbreak of the Corona pandemic. But in fact, we've just seen that this was not the case. We had a stagnation of the stock price starting in mid 2015, and this translates into price earnings, or into a stock which got first expensive and then less expensive again. Let's zoom in here. Then you can see the multiples. You can see different multiples calculated on earnings, both reported, adjusted earnings, and operating cash flow. And then you can see that during the financial crisis, which is started here in 2009, the price earnings was between 12 and 13, and it went up till 20. So it didn't double, but it went up considerably. And then during the phase of stagnation, not from the earnings perspective, but from the price perspective of the stock, then the stock got cheaper again, and the multiples dropped. The price earnings dropped from about 21 to 14 only. And now it got a boost. It got a boost again, the multiples, because the earnings and cash flows dramatically declined due to the Corona crisis, of course. We will dig deeper into the valuation of fair value calculation of Walt Disney stock very soon. So basically what we can say is that it was a good investment. The stock was a promising investment because Walt Disney managed to increase its earnings and cash flows in the long run, also could afford to increase dividends. We have a dividend increase, we see it here using the matrix of within the last 10 years, compound annual growth rate, yearly average growth of 18%, 80.5%, which is very much, but we also see it here regarding the last 5 years. It slowed down considerably, 6.5% about, and now we have the estimate is a dividend cut. Dividend will be cut about in half, so there's a 42% drop. It should even be 50% probably, to be exact, because the dividends which should be payable normally in June, if I remember well, Walt Disney pays dividends twice a year, which is very uncommon for an English stock, for an English-speaking company. I wanted to say, for a US stock, normally they pay quarterly, they pay semi-annually only. But okay, normal. It's not that important how many times they pay, because if you look at the whole year as a long-term investor, it makes no difference, of course. But this year only payment frequency of 1, like in Germany. In Germany, we always have payment frequency of 1 only. Okay, which this means that you will see this drop, expected drop of the dividends, and then probably we will see a dividend increase again. Okay. What's also interesting is the chart below this one, which shows you the sales and the margins. And if you look here, you have the operating and the net margins I've shown. You can see that the revenues were growing for a very long time, mostly steadily. Also margins increased. And this is a very nice combination. If the sales go up and each dollar of sale gets worth more because the margins increase, is a boost of the cash flows and earnings, and this is exactly what happened. But here you see something very interesting, that margins decreased considerably. Operating margins decreased if you start from 2018 with 25% to about 17%, and it dropped about 8%. And this has nothing to do with the coronavirus. It already happened last year. Now, of course, margins declined even more, but that's due to the closure of the theme parks and the halt of the cruise lines and so on. But here, what happened here? Why did the margins decrease considerably? If you scroll down to the next chart, then you will get an idea what happened. Then you see, get rid of the treasury stocks. Then you will see that the balance sheet considerably increased, and I already told you the reason why, because of this merger, because of the acquisition of 21st Century Fox by Disney. So they incorporated 21st Century Fox also in their balance sheet, and yes, you see how the goodwill got a boost, which means that the management of Walt Disney decided to buy 21st Century Fox for a price much higher than 21st Century Fox was worth, simply by looking at the balance sheet. And they also increased their debts, but they also have more assets, of course, because they took the assets from 21st Century Fox. And obviously 21st Century Fox has less margins or lower margins than Walt Disney have. So this new Walt Disney, including 21st Century Fox, had lower margins. That's one reason. The second reason will be, I've also shown, will be the new fourth segment, direct to consumer, which is still posting losses. This is also a reason why the margins went down. But that's an investment. Both this acquisition and the fourth new streaming segment, these are investments, and it happens that investments lead to lower margins. That's not a problem by itself. If in the future margins will go up and revenues will go up again thanks to these investments. And we have seen by this jump here of the stock price, this really nice jump here, that the stock market received the announcement of the fourth segment of the streaming services, Disney Plus especially, very well. And they are successful. My colleague showed it here. You can see, for example, how many subscribers Disney Plus and Hulu and ESPN Plus, they all together, they already have about half of all subscribers of Netflix, which is the behemoth of the streaming services, within a very short period of time. And the different segments, they boost or they help each other, because we have here this segment producing studio entertainment, producing all these blockbusters, and media networks producing series, television series, and so on. And this can be made exclusive for subscribers, for example, of Disney Plus. So Disney has some good arguments for why Disney Plus will be successful. It's already successful. Okay, then I think that's the overview about how the company did and about the current situation. The current situation is a little bit problematic due to Corona. You can see it here. Look at the devastating effect of Corona. You really see that here the earnings and cash flows really get a considerable drop, and it's no wonder why management decided to cut dividends here. If you can see that the dividends are no longer covered by the free cash flow, and management could decide to still pay dividends, but then it would be dividends financed from the substance, financed from the balance sheet from here. And it doesn't make a company more valuable if management decides to continue paying dividends, which are paid from the substance of the company itself instead of the earnings and cash flows. So for me, the decision is absolutely fine of the management. What's also interesting is, according to the estimates, that the analysts don't see a very fast recovery. So you see that the earnings, for example, even in 2020, are seen much below the earnings of the state before the Corona crisis, about the earnings back in 2013. This is very important if we look at the current valuation of the stock to get an idea if the stock is a nice buy or not. But before, let's check the dividend and the dividend history, just to give you an idea about Walt Disney as a dividend stock. And you use what's interesting here is, if you look at here the historic dividend payments, you see that it was a very reliable dividend stock so far till now, unfortunately. And we can also see here, second observation, that the dividends were about in the last years between a range of 1% and about 2%. 2% only during the financial crisis, even slightly above for a single month, but mostly between 1% and 1.75%. So this is the historic dividend yield. And there are some ups, some downs, and right now, after the dividend cut, we are below 1%. So it's not a typical dividend stock, because the dividend is very low right now. then look at the valuation. That's the last thing we do, and it's a very important thing to do. First, get rid of all these different valuations, because we must choose the right time frame for the fair value calculation based on the different multiples we have. We have 2 times the earnings, reported and adjusted earnings. We have the operating cash flow and the dividend as well. And based on all these different metrics, we can calculate fair values. Get rid of the stock price also, and then you see here the different multiples. And I think, for example, 2002 is not representative, where the earnings were much too low, resulting in very high multiples. But starting in 2004, or maybe 2006, if you want a little bit more ambitious, or no, a little bit more careful regarding the valuation, then we take this time frame. And now we have different multiples calculated. You see it here. And then get rid of the underlying matrix and get the new ones. But first we see the stock price, and now let's see what the fair value calculations say. This is a fair value calculation based on reported earnings, fair value calculation based on adjusted earnings, based on the operating cash flow, and based on the dividends. And let's zoom in a little, or let's zoom out again. Get rid of the dividends, because I think the fair value dividend is not very important. Dividends are so low that I don't think you will buy the Walt Disney stock because of 1 or 1.5% of dividend yield. This shouldn't be the decisive metric for you. Rather, looking at the earnings and operating cash flows makes more sense to me. And we can see here that the stock price in the history respected the different fair values, which are rather close to each other, which is a very good sign. And then here things got a little bit wild when regarding the acquisition of 21st Century Fox. That's one reason, and then we have the corona outbreak, but we can still work with this very well, I think. Here you see that we had an overvaluation of the stock till 2015, mid-2015, and you remember here that I showed it to you. Here the stock price really went up, and here the stock was overvalued, and then the stock price made a pause, made a break, and this is exactly what you can see here. Yes, the stock price went up considerably, and the earnings and cash flows, they also went up, but the stock price went up too much. So the stock was overvalued, and then we have had this phase of stagnation when the stock price went sidewards, and the fair values had the time to catch up with the stock price. And then, okay, all these things happened. I already said, the acquisition and the pandemic. Now we look at the most interesting part of this chart, the present. The present is exactly here. The stock price is $150 US right now, and you see that the fair values are much below the current stock price. This doesn't mean that the stock is completely overvalued, as you might guess first when you look at this and you think that the stock is completely overvalued. But the reason why the stock is still more expensive than the fair values indicate is that this the drop of the earnings and cash flows is artificial. Artificial is the pandemic. It's an unforeseen negative event. It's an event which will be hopefully unique, and it's an event Walt Disney will survive, and it will regain their old strength after this pandemic. That's what the market is pricing in also. It's not an inherent weakness of Walt Disney's business, but it's something. It's this artificial event on the one hand. On the other hand, you will see that according to the estimates, Walt Disney needs time to recover from this, and they have to digest these acquisitions. They will have to digest the fourth segment to turn it profitable, the streaming segment, and they will have to digest the effects of the corona pandemic, and all this takes time, and this translates into lower operating cash flows and earnings. You can see it here just at the adjusted earnings here. Then you will see it takes time for the stock to come, or for the earnings to come back where they have been before the acquisition of 21st Century Fox. And for this reason, the stock to me is overvalued right now. Even if these fair values here are unrealistically low, I think that the fair values in the near future are much more realistic. And at the value, these helper lines here, we are here today. This is the current stock price. And if you buy the stock today, then don't expect high capital gains for the midterm. Let's say at least these 2.5 years here. Don't expect capital gains. Rather, according to me and according to my opinion, it's more probable that capital losses will occur, because the stock market gets aware that Walt Disney takes time to recover, to come back to old earning strength. And in this phase, if this happens within the next month, then it may happen that the stock price goes down. Maybe not so far, but it's enough. If the stock price, for example, goes down like this, then you already have capital losses and a dividend yield of about 1%, 1.2%, something like that, which is not very much. It doesn't compensate you for capital losses. And this is why I think, in my opinion, the stock is not a buy today. It's not a bad company. I think it's a good company. They have very sound business models, very sound segments. As we have seen here, they invest into the future. They do a lot of things right. I also think the dividend cut was okay. But the stock price right now, because Walt Disney had this triple things to digest. I already said these acquisitions, the pandemic effect of Corona, and then the new streaming segment, and all this takes a lot of time, and this translates into sluggish earnings growth. And for me, the stock is not a buy right now due to these valuation reasons. Okay, that was my opinion about Walt Disney. You can read the blog article here. I will paste the link below the description. Thanks for watching. See you next time. Bye bye.